Hi, I'm Roger Montgomery from Montgomery Investment Management and welcome to this week's Video Insight. Before we get started, a quick lesson on the sorts of businesses that we look for. Imagine a bank account with $10 million deposited in it and remarkably earning 20% per annum. Now imagine that this bank account pays all of the interest out to the deposit holder each year. None of it is retained and compounded. What would you pay for that bank account today? Well, if you're happy with a 10% return on your money, you could easily pay twice the equity in the bank account. In other words, you could pay $20 million for that $10 million bank account. If you're happy with a 5% return on your money, you could pay $40 million. Suppose you were happy with a 5% return and you paid $40 million for that bank account. Would you get the $40 million back in 10 years' time if you decided to sell that particular bank account? Remembering, of course, that the $2 million of interest that's being paid out each year is being eroded by inflation, as is the $10 million that's deposited in the bank account. If interest rates were higher at any point in the next 10 years or at the end of 10 years, it's quite possible that you don't make your $40 million back. What I've just described is essentially a bond, and we want a very big discount to an intrinsic value for a company that behaves like a bond. Far better is it to own a business like the bank account, but one that earns 20% and is able to retain a proportion or all of the profits and compound them over 10 years. In 10 years' time, there'll be more than $60 million in that bank account, and we should be able to sell it for some multiple of that, ensuring that our purchase at $40 million is going to give us a handsome return. The first bank account is what investors have been chasing over the last 3 years. High dividend yielding but low growth companies. In the next few years, with China slowing down and the risk of some stress on their banking system, the result of $34 trillion of debt, as well as companies suffering as a result of the slowdown, it's quite possible that both global economic slowdowns, combined with higher long bond rates, might mean that those investors, if they continue to chase those high yielding stocks, will come unstuck. So over the next few years, it's important, now that the good times are over, to be looking for businesses that can retain profits and compound those profits at high rates of return. Look forward to seeing you again next week or the week after, and in the meantime, be sure to follow us on Facebook or Twitter.